Yeah, to your point, Egon, too, I want to be clear. You and I, since day one, have always thought of ourselves almost ironically more as historians than market. This is nothing new. This hysteria on the tariffs is certainly making easy headlines, political and otherwise. But as you and I have talked about, this market has been a huge red inflated balloon just looking for a needle or a bug looking for a windshield. And it could have been any number of potential triggers or catalysts or needles, a black swan event, a geopolitical event, a war, a bank failure, a rate policy failure. But, at the end of the day, markets, which we've always thought were Fed driven and easy money driven and rate driven and frankly central bank driven, whether you look at Rome or you look at more modern capital markets, every market crisis is ultimately a liquidity crisis. There's just not enough liquidity. And let's be clear, when you're in debt up to your ears with 37 trillion in public debt and debt to GDP ratio of 125%, you're a debt-soaked nation. You're a desperate nation. So you have a debt crisis, and a debt crisis is really just another name for a credit crisis. And a credit crisis is, of course, a liquidity crisis. And without getting into all the history, but just in recent memory, wasn't that long ago, in 2019, we had a repo crisis, which was a disaster. That was just a credit crisis. In 2020, the markets tanked by over 35%, but for unlimited QE, which followed. But the COVID crisis of March 2020 was just a liquidity crisis. And then, of course, in 2022, we had the higher for longer policies of Powell to quote unquote fight inflation. That failed. And we had the worst nominal returns in stocks and bonds since 1871. That too was a liquidity crisis driven by the bond market and debt markets. And then in 2023, you and I, we saw 3 of the 4 largest bank failures in U.S. history. That wasn't even a banking crisis. That was a liquidity crisis driven by a credit crisis. And here we are looking at tariffs. And it's tariffs. But no, it's no buyers for our U.S. treasuries, no liquidity, no GDP, no P in the GDP, no tax receipts enough to cover debt. So we are desperate. The tariffs are desperate. And there is sadly, a massive disconnect between the real economy in the U.S. and what was a ripping, seemingly immortal stock market up until a few days ago. And I think now, because markets are showing their weakness, people are actually realizing not only do we have a market crisis right now, we can now see the recessionary forces, which we've ignored for the last 2 or 3 years. I've been arguing for a long time. We're in a recession, and I won't get into all the weeds, the proof. I've written ad nauseum about it, and it's only getting worse. I mean, retail sales are negative, for gosh sakes, and bond spreads, all these things. The recession indicators are overwhelming. Well, you have to look at Trump's personality. I'm no expert on it. Like, in some ways, you and I can defend Trump. In other ways, we're scratching our heads. I mean, he has a nostalgic, very patriotic view that America should be first. America can be first. It can be great again. That we are self-sufficient enough to be a mercantile, nationalistic, isolationist kind of economy, and that we'll get there. And that these tariffs, in his mind, and again, to play the devil's advocate, especially when you're looking at 100% tariffs on China, to me, that's mutually assured destruction. We need each other's markets. But in Trump's mind, and I'm speculating, but I don't think it's a huge leap to answer your question, he really has a key goal to reshore what was outsourced in 2001 during the W2, when the American dream was made in China, when CEOs across the board in the U.S. decided to go for cheaper labor overseas, primarily in Asia and China, and that all your Apple phones, etc., and lawn care products and even outdoor grills are actually made in China, from tech to, to simple goods. And if he puts 100% tariff on China imports, well, that means any company, including many, many American companies, realize they have to get their butts and their labor back into the U.S. So we're playing checkers. Americans are checkers players. I'm sorry, I love America. We're a young country. We're kind of adolescent. China is an old country. It has many problems, but it has a history of thinking long-sighted. It reminds me of Ronnie Sturflick's speech he made years ago in Munich with us. Like the American Indians, they think many generations ahead. But American politicians think one quarter ahead, or one headline ahead, or one election cycle, midterms ahead. So to your point, these are making huge reverberations. He's a bull or a bear in a china shop, very short-sighted. He does think longer term, and Scott Bessent has said this too, short-term pain, long-term gain. That's their thinking, that this is necessary pain to reshore jobs, make America great again, bring productivity back to America. We lost that in 2001. This is what it's going to take. Of course, it's going to be extremely inflationary because we have a goods deficit at the highest in history. So how are we going to pay for these higher priced goods? The irony is, the good news is, oh, don't worry about inflation because there's going to be such a weaker demand, i.e. a recession, and probably because markets are going to crash. Those are very disinflationary forces. That's very funny. Basically means, well, on the back of the middle class or the average American, you're just going to have lower demand, higher recessionary forces, and probably a market implosion. So that'll take care of inflation. That's a painful way of dealing with the inflation causes of these tariffs. So to your point, yes, absolutely short-sighted. They would argue it's long-sighted, that this is necessary. Jim Rickards thinks it's the best thing we've ever done in our policy. We got to do this. I remind people, to your point on history, we tried this in 1929 when we had an over-levered bubble economy, debt-soaked economy. McKinley tariffs came in. Within 3 years, the Dow lost over 80%, and the Great Depression followed. Does history rhyme or repeat? We'll see. Some will say this is a necessary measure. It's a desperate measure, but we have to do it. But be careful what you ask for, because this is going to not just disrupt stock markets, which we're going to break for a number of any reasons anyway. Global politics, geopolitics, extraordinary. Well, think about it too, to your point, how short-sighted this is. Who's the traditionally biggest buyers of our debt? U.S. debt is China and Japan. China is no longer going to be buying U.S. treasuries. They'll be selling. And who will be buying U.S. treasuries? It's going to be bazooka money from the Fed, inflationary. The inflation is the end game here, no doubt. We may see disinflationary forces, but the only way to solve this lack of love and trust for a weaponized, over-indebted U.S. IOU is for the Fed to print money to buy it. That's inflationary, currency debasing. Couldn't be a more perfect scenario for gold, which is why treasuries aren't the tier one asset anymore. It's not the safe haven. Even in this recent carnage, treasuries haven't been ripping. They've been falling. That's an interesting sign. And what? Gold is holding its own much better than U.S. treasuries. And relative to the stock market volatility, it's doing its job. In the midst of all this craziness, many people are still waiting for gold to fall off 30-40% like in 2008 in a market crisis. Is this a crisis like 2008? To be determined. But gold is in a very different macro setting now. It is a tier one reserve asset. It is a safe haven. U.S. IOUs are not. And yet people are still waiting for a dramatic pullback in gold to understand it. How can you help people understand that this is a different world now and that gold is a far better savings asset and reserve asset than an IOU from a broke Uncle Sam? Literally, the American model is Western model. It is the Keynesian model. It's basically debt has advantages to a point, but like the Greeks and Roman philosophers said, moderation all things. We've taken debt way past moderation. The Austrian school, which is not taught in American high schools, colleges, or business schools, says that debt, when overextended, destroys the nation, destroys the currency. We've written and talked about this quantifiably for years. Americans, and certainly American politicians, the vast majority of them have zero understanding of history and economics, let alone the Constitution, ironically, just don't see this. And I think that's what's very scary. Sadly, Pavlovian investors still think the next 10 years will roughly be like the last 10 years. The Fed will save us. Every dip is a buy, and we'll get through this too. And to your point, this is a structural, systemic problem that has now hit a tipping point. And I think to think of the next 10 years like the last 10 years is very dangerous. There's very few places to hide. Very few asset classes. You and I have seen this with family offices looking to unload their private credit pools, which are the new weapons of mass destruction. They're marked to tier 4 status. There's no real market or liquidity for them. The S&P is far too overvalued and volatile. But all this debt and this idea, this fantasy that the debt isn't a problem because the central banks or the government or the Fed has our back is a misunderstanding of history. Because if no one's buying that debt and productivity doesn't surpass that debt, or tax receipts don't surpass that debt, or income, you have a massive problem. And that can only be solved through chaos and desperation. The tariffs are a form of desperation. The Bitcoin strategic reserve is a form of desperation. All these desperate measures are a form of desperation, but inevitably, we're looking inward, as Ray Dalio said, because there's massive shifts now. Geopolitically, the dollar is no longer US-centric. Trade with de-dollarization, the rise of the BRICS, all of which have their own problems, but they're moving away from the dollar. The indications that the U.S. and the U.S. dollar and U.S. Treasury, now weaponized, are no longer the center of the world is obvious. It's no longer safe within our own border. It's going to be debased and inflated. And even politically, there are so many changes. So we are absolutely aware of history in motion right now. It's hard to see when you're in it. But these are not just headlines or themes. De-dollarization, debasement of currency, debt as a destructive tool for all history are part of sound economics and unsound disasters, which we are seeing now. And again, this is ultimately not a tariff crisis, although the tariffs are a disaster in a lot of ways. It is a debt crisis. And these desperate measures are the response to a debt crisis. It's a far little too much too late. And as I've said many times, Santa Claus, Mother Teresa, 5 Nobel laureates are not going to solve this debt crisis now. And I think these tariffs are going to make it more volatile for the markets. I mean, the VIX at 53 and counting. It's incredible. Treasuries not being overbought. It's incredible. People need to look at the history of markets, the history of tariffs, the history of debt, and they'll see that the only solution is going to be debasement, financial repression, higher currency destruction, more desperate measures geopolitically. Even a reset has to have credibility. All of these things point towards physical gold. This is not a gold bug selling your book story. This is history. This is math. This is common sense. You've known it for 25 plus years. You bought in early, but it's not the price appreciation you were chasing. It was an understanding of sound money and the notion that to be rich, you have to stay rich. You have to preserve your wealth. This is not a speculation, get rich quick asset. This is a don't get poor, don't get exploited asset. And I think more and more people hopefully will figure that out. But to your point, even family offices and sophisticated investors are still speculating in SPACs, private credit pools, private equity, hedge funds, playing the old game like history doesn't change. Well, history's changing right in front of us. I think many people are woefully unprepared and unsophisticated. Even at the high-end level, I've worked in family offices. They're very bright people, but they're very consensus thinking, almost conditioned to believe that we're too big to fail, that there'll always be a solution. It's never going to work. It's monetary debasement now. It's the only solution forward. It's financial repression. As you were saying, there's a list of other social unrest, these tensions geopolitically, nationally, internally. In terms of preparation, it's usually too little too late. There is a slight understanding increasing now that everything is breaking down around them, and so there has to be some solution. People are slowly catching on, but the man on the street, sadly, to your point, anyone can afford some grams, but many of them don't even have the money to get through the month. I was talking to my mother, I mentioned this in a recent interview. It's quite sad. In my hometown in Michigan, which is a good classic example of strong Midwestern America, these are proud people. They're hardworking people. They're not sophisticated on Fed policy, interest rates, bond spreads. Why should they be? But they're feeling it. They're broke. And there are signs, I'll wash your car, in front of their house. They're stressed. They're indebted. I see in my little village in France, you have to pay to take your trash out with a little cart. An old woman needed help just to take the trash out. So this is quite tragic. So for many, many people, it's not even a question of having any options. Most people have some options. The ultra high net worth have no excuse now to be caught off-footed like this, to be in SPACs, credit pools, private equity, and a bubbling stock market. They're not managing risk because they're thinking as groupthink. They're woefully ignorant of history and no fun at a cocktail party. When markets are rising, everyone from a Goldman Sachs alumni pool looks like a genius. When markets tank for obvious reasons and obvious signals, they blame it on an extraneous event, couldn't be seen. It's disingenuous. It's groupthink. It's banker think. It's Harvard think. It's Wharton think. I've seen it 1,000 times. I've seen it from Wall Street. It's not to call everyone a fool. They're trying to get by in a system that doesn't reward honest thinking. Everyone has to be a bull on Wall Street or you don't keep your job. Bearish cynicism is bad for business. What we have the advantage of is having no constraints by a corporate board or shareholders. We can speak what we believe is the honest, blunt truth. What people do with that is up to them. Do your own homework. You'll see it. And more and more people, certainly the central banks of the East, even the BIS, of which I'm no friend, sees it. So the evidence is there if you want to find it. And you can decide what you want to do. Facts are stubborn things, but you have to decide what to do with those facts. If you want to save in U.S. Treasuries and risk yourself on the SPACs stock market, that's your call.